In today's video, I'll share with you 3 Canadian dividend stocks that are currently on my watch list. As you might know, over the last year, we've lived many different threats on the market. For example, the high inflationary pressure combined with the potential of a future recession. But the Canadian market has been able to outperform the American market over that period. Plus, I personally believe that the 3 stocks on my watch list that I'm about to share with you have some insanely high potential of growth in the future, combined with some incredible dividend income that is given to their shareholders. So let's get to it right now. Starting with my first pick, which is the Nova Scotia Bank with the ticker BNS. This bank is currently a member of the 5 biggest banks in Canada, which includes members such as RBC, TD, CNBC, and BMO. And with a current market cap of over $70 billion at the moment, they've been managing over $345 billion of assets in 2021. As a great bank, they are obviously offering many kinds of financial services and products to their customers. For example, bank accounts, insurance, loans, mortgage, and credit cards. As you can see, they have a great sustainable business model on the long term that can be proven by their super great dividend history of more than 190 years in a row. But that's not all. What is really interesting about this kind of bank is their South American exposure. Indeed, they currently have over 2,000 branches in more than 30 different countries in pretty much every single continent, which makes it Canada's most international bank. So on your side, if you're looking to invest in a Canadian bank that has some wide international exposure, well, BNS might be your lucky pick. Despite that, we've seen that recently it has lost a lot of value compared to the other big banks. Plus, in their most recent earnings report, we can see that they have both missed the predictions for the earnings per share and for the revenue. Why would I want to invest in that company? Well, as a long-term investor, as you can understand, I am investing for the future. And when I see some great companies that are actually in discount and that are giving some great dividends to their shareholders, I usually want to jump on the boat. Plus, what is really interesting about this particular company is that it is giving a great DRIP program, meaning that on your side, you can simply reinvest all the dividends that you will receive to buy and purchase new shares. And so the lowest the price of this company will go, the easier it's going to be for you to DRIP on it. Plus, with the ex-dividend date being the 3rd of April 2023, it means that on your side, you are not too late yet to buy this company and receive its next dividend. But before you see if this company is a great pick for you or not, let's make a quick fundamental analysis on it. For the valuation measures of the Nova Scotia Bank, we can see that this company currently worth about $80 billion with a super low price-to-earning ratio of less than 10, where this indicator is showing that at the moment, this company would be undervalued. Over the last 12 months, we can see that BNS has been able to have some incredibly high profit and operating margin, as well as a great return on equity of about 12%. For that same period, we can see that their total revenue has been of close to $30 billion. However, with a slight decrease of about 6% in their latest quarterly revenue growth compared to the same quarter but in 2021. And in terms of their quarterly earnings growth, we can see that it's pretty much the same scenario where they have been diminishing of about 34%. But a great news about this company is that they have close to 2 times the position in cash compared to what is their current debt. After, to find what is the volatility of this stock, we'll be using, as always, the beta on a 5 years period. And we can see that with a beta of about 0.94, it is pretty much the same volatility as the overall market. But despite that, we can see that over the last 52 weeks, the stock has been down of about 26% compared to the overall market that has been down of about 7%. And at the moment, this bank is giving a great 6% of dividend with a pretty good payout ratio of only about 56%, which is showing that this dividend is quite sustainable on the long term. In terms of their total revenue, we can see that over the last 12 months, they've been able to grow pretty well, except between 2020 and 2021 because of the pandemic. But despite that, we can see a pretty good progression over their net income. And in terms of their cash flow from operations, we can see that this bank has had 2 years where it has had some negative cash flow. But after the end of the pandemic in 2022, we can see that this company has had some pretty positive cash flow from operations in that last year. And the picture is pretty much the same for their free cash flow progression. Now for the second pick on my list, I've decided to go with a very stable company that is well welcome in those high inflation times, which is the company Loblaws with the ticker L.to. Loblaws is currently Canada's largest grocery, pharmacy, and global merchandise retailer. And with over 2,100 different shops all around Canada, they are operating in Canada's most interesting markets, which are Ontario, Quebec, and British Columbia. And as you can see by its super low beta, it is one of the safest investments that you can currently do on the stock market. Because if there is one thing that we will continue to have massive needs for in the future, it is really the grocery and the pharmacy part. Because despite periods of inflation and wars, we will continue to have massive and basic needs in the future to heal and to feed ourselves. And as being one of the largest brands in the countries with different subsidiaries such as the Dominion stores, the Atlantic stores, Maxi, and Pharmaprix, Loblaws should continue to see some great and some steady growth over the next couple of decades. With all of those subsidiaries, in 2021, Loblaws has been able to generate over $53 billion of revenue, which makes it Canada's largest food retailer before of Sobeys that has made about $28 billion of revenue in that year. But what is their biggest competitive advantage that helped them to differentiate themselves compared to their competitors is mainly the fact that they are able to offer some highly discounted products to their customers. In fact, companies such as Maxi over here in Quebec have the policies to give to the different customers the lowest price possible. Plus, an interesting fact about Loblaws shops is that over 90% of all Canadians live within an area of 10 kilometers of a Loblaws store. So they definitely have some strategic locations. But compared to the other two stocks on my list, you can understand that this company is giving a lower dividend that has however been growing pretty fast over the last couple of years. But at the same time, over the last year, we can see that this stock has been able quite well to resist to the inflationary pressure. And as you might know, if you follow my portfolio update, I currently don't have any kind of grocery or pharmaceutical stocks in my portfolio, meaning that Loblaws would be a pretty good option for me personally. But now, let's see what the valuation measures are telling about Loblaws. Now for the fundamental analysis of Loblaws, we can see that this company currently worth about $37 billion with a quite fair price-to-earning ratio of about 20. Compared to BNS, however, we can see that they have some lower profit and operating margin, but with an excellent return on equity over the last 12 months of about 17%. And for that same period, we can see that they've been able to generate some revenue of about $56 billion, with some growth of about 10% in their latest quarterly revenue, but with a diminution of about 28% for their latest quarterly earnings growth. Unfortunately, we can also see that this company has a super small position in cash of only about $2 billion compared to its massive $17 billion of debt. But as I told you earlier, this company has some super small volatility compared to the market of only about 0.06, which has resulted in a slight gain of about 2% over the last year, and with a dividend yield of about 1.39% at the moment, we can see that they have a super small payout ratio of only about 27%, meaning that they are not using too much of their net income to pay the dividends to their shareholders. And for their total revenue over the last 4 years, we can see a pretty good progression, which has led to a great increase for their total net income. But unfortunately, for their cash flow from operating activities, we can see that they've been diminishing since 2020, despite a slight increase between 2019 and 2020. And once again, it is pretty much the same for the total free cash flow. And finally, for the last stock on my list, it is the company Enbridge with the ticker ENB. If you've seen my past videos on my favorite Canadian dividend stocks, you might have noticed that Enbridge pretty much always come up in my list. Indeed, this energy company is one of my favorite in my portfolio, and it is also one of the world's largest energy companies and also the largest in Canada. Its main role is to transport and to distribute many different kinds of energy such as the oil, the natural gas liquids, and the green renewable energy. Plus on their side, Enbridge is mainly focusing at the moment to develop their North American market. It is why they currently move about 30% of the total crude oil production in North America. They also transport about 20% of the total natural gas consumed in the US, and they operate North America's third largest natural gas utility by consumer count. Plus, what is really interesting about this business is that they have been recently working on the renewable energy branch, notably with their recent policies of net zero gas emission by 2050, and recently they've been able to increase the production of their green renewable energy where where they can currently meet the requirement of electricity of about 976 homes all around the country. In my opinion, it is one of the best companies that you can have in your portfolio if you want to enjoy the pros of having an oil company, notably knowing the fact that the oil is considered as one of the best hedge against the inflation, but at the same time to also have a renewable energy to enjoy the future growth of it. As you can understand, Enbridge has a great diversified and sustainable business model on the long term. Plus, what is really interesting about Enbridge is that they are currently giving over 6% of quarterly dividends to their shareholders, but compared to BNS, they don't have the possibility to make some drip on it. And with the recent drop that they've seen over the last year, it could be a great buying opportunity for the investors. But now, let's make a quick fundamental analysis on this company. And for the last company on my list, we can see that Enbridge currently worth about $106 billion, with however a quite higher price to earning ratio of about 40 compared to the two first stocks on my list. But despite that, they've been able to achieve some great profit and an excellent operating margin over the last 12 months of about 16%, with a pretty fair return on equity of about 4.64%. And for that same period, they've been able to generate some revenue of about $53 billion, with a great growth of about 7% in their latest quarterly revenue. However, one of the things that I don't really like about this company is their super small cash position of about $1 billion compared to their massive debt of about $81 billion. But despite that, over the last 5 years, we can see that this company has been less volatile than the overall market. But over the last year, we can see that it has lost slightly more value compared to the overall market. But as I told you earlier, what is the most interesting thing about this company is their massive dividend of close to 7% per year. And in their case, we won't be using the classical payout ratio, which is pretty high, but we'll be using the DCF payout ratio. And at the moment, the DCF payout ratio, or if you prefer the discounted cash flow payout ratio, is about between 60 and 70%, which is showing that the dividend should be still sustainable on the long term. And over the last 4 years, we can see pretty good growth in the total revenue of this company, except for 2020, where we can see that the total revenue has been dropping because obviously of the old effect of the pandemic, and because, for example, there was a lot of people that were not using their automobile as well as in the past. And so it is why we can see that the net income of this company has been fluctuating a lot over the last 4 years. But despite that, in terms of their cash flow from operating activities, they've been able to grow them pretty well over the same period, which has obviously led to a massive increase in their free cash flow. As you've been able to see in this video, there are currently plenty of great Canadian dividend stocks to keep an eye on for 2023. However, there is one Canadian stock that has lost over 20% of its value over the last year, and its name is Shopify. If you want to understand why it has lost so much value and is it a great stock to buy at the moment, well, check out the video that's gonna be right over here, and I will see you soon. Peace!